Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. I know I always say I'm excited for every show that I do, and I really am, but I'm super excited for today's show. We've got Joseph Bramante with us again. I think this is probably his fourth or fifth time on the podcast. So, Joseph, welcome to the show today, man.
Hey, Brian, glad to be back. It's always a pleasure to be on the show.
Yeah, always good to have you. I learn a lot when you come on the show too. So always inviting you back. It's almost an annual thing now. But let's start talking about you. Tell us a little bit about yourself and kind of walk us through how you got into multifamily.
Yeah, so, 13 years ago, I was working for Exxon. At that point, I had about 5 years experience with Exxon. I was based overseas and I was living on a compound. We're building a project out basically in the jungle. We're building this LNG facility and had a whole lot of free time on my hand. And there was really no internet. It was really slow.
Mm-hmm.
And so you get off of work and you had nothing to do. And
Mm-hmm.
my managers at the time were rotating. So they would come home for 4 weeks and then come back to the job site for 4 weeks. And every
Mm-hmm.
time they came back, this was 2009, 2010, housing crash just happened. So they're picking up all these cheap little rental houses in Houston
Mm-hmm.
for nothing, and then just and renting them out and making these crazy returns. And so I had this one particular manager, every time he came back to the site, he had this new house that he had bought. And so it got me interested and started learning more about it and downloaded some books
Mm-hmm.
and read just a couple books. And the first book was, I think it's called like Real Estate Investing. There's this, I forget the exact title, but anyways, this book on real estate investing. And it just said single family is great, but
Mm-hmm.
if you have the money, go into multifamily, just go straight commercial. And I did, I was making a lot of money overseas, had
Yep.
no expenses, had already paid off my student loans and everything. I did, I had subscribed to the whole Dave Ramsey model early on and did all that. And then once I'd paid off everything, I was like, all right, now what? So then read these books on real estate investing, convinced one of my fellow employees there to go in with me. And at first we were trying to buy a bunch of houses. And so we were going to buy like 80 houses at once and had this big spreadsheet on how we're going to take them all down. And we were calling all these banks from Papua New Guinea. So
Mm-hmm.
kind of the beautiful thing about the time zones there was I would finish work around 5 or 6,
Mm-hmm.
and that would be 8 or 9 o'clock in Houston. So
Mm-hmm.
I could start basically get half a day in Houston. So do a full day in Papua New Guinea, half day in Houston. And I would pick up the phone and just call these banks and these different brokers, try and get a loan to buy all these houses. And apparently that's not how you did things back then. You couldn't
No.
just do a big portfolio loan on your first deal ever to buy 80 houses. Like, I don't know, but those were kind of thoughts that went through my head back then. And
Yeah.
so eventually one of the bankers was just like, go buy an apartment complex. Don't buy 80 houses, go buy an apartment complex.
Yeah.
But it was that, and I was reading the books, and I've read a bunch of other books on like 3 or 4 other books on multifamily investing. And
Mm-hmm.
there was one called Multifamily Millions by David Lindahl.
Yep.
And I love that book. It's still one of my favorite books and has all the formulas in there. And I just, as an engineer, I just kind of fell in love with the formulas and started creating these different models and talking to these different brokers on multifamily and went on LoopNet, and found some
Yeah.
deals and some brokers. And 6 months later, next thing you know, I'm buying my first deal, still based in Papua New Guinea. I hadn't seen the deal yet. I just saw some
Yeah.
photos. My partner, the other employee I was telling you about, he was a rotator. So he got to actually see the property. And on his time off, he went, looked at the property, thumbs
Mm-hmm.
up, looks good. The broker did the underwriting for us. Basically, it was a 1-page Excel file with maybe 3 or 4 rows. It was
Mm-hmm.
incredibly basic, but
Yep.
back then you were buying things at a 14% cap rate. So there's a pretty big margin of error.
Yeah.
You could basically, if you could fog a mirror, you could buy a property and you'd be okay. And so we bought that deal, those 26 units.
Mm-hmm.
I remember one of the interesting things on the closing, because everybody knows you go to a title company, you do your closing, these little things you kind of take for granted. I didn't have a title company in Papua New Guinea. So
Yep.
I had to go to the US Embassy to get my loan documents notarized.
Yeah.
And I was 26 years old at the time. And I
Mm-hmm.
remember these, much older government officials, working at the embassy. Here I am coming into this building, which is built like, Fort Knox, things like
Yeah.
it's ready to take an attack.
Yeah.
And I'm going in there just, all doughy eyed, kind of 26-year-old me, not knowing, completely ignorant to the world. And these guys are like, you you sure you know what you're doing? Like signing these forms. And I'm
Yep.
like, yeah, I got this. We're good. And the other thing I remember, it's really expensive, by the way, to get
Mhm.
things notarized at the U.S. Embassy. It was like $100 a page.
Oh my
So
goodness.
yeah, it wasn't.
Yeah.
I was like, anyway, we got it done.
Yeah.
And, but
Well, I mean,
that's
I've done a lot of embassy stuff, but I was always, part of the embassy team when I was down there. Hate to tell you this, but they notarized stuff for me for free. So, I don't know,
that's
but
yeah. But you're
yeah,
also, you're working for the government though. I was
I
based.
was working for the government. Exactly. And
Yeah,
that's probably why, and
yeah.
especially when you're overseas and you can't just go do it
I was on
any.
the benefits. You didn't see that when you enrolled? Free
Yeah.
notaries.
Free notaries. Yeah.
Yeah, totally made it worth it.
Actually, fun fact, and I don't want to get us too far off track, but the United States Code says that there's certain military members that are automatic notaries. And I was actually a notary in several units when we were serving overseas because, I'm allowed to do it, and
Yeah.
no stamp required. I just sign and say I'm a notary. But anyway, that's beside the point. But had we known each other at the time, you could have come to me. I would have notarized your documents and only asked for like 10% of the GP. No big
Well, again, we didn't know what we were doing.
Yeah.
There was no GP. It was an LLC. It was a 50-50 split. Me and my
Mhm.
partner, you brought your money, I brought mine, and that was it. And we put in half. And the intent was we'll both work on this together. Really, this was just an investment, just like you'd buy a house. Like
Yeah.
we both planned on continuing to work for Exxon long term. Well, I mean, until we had enough real estate, we can then retire and quit and be done. At least for me, there was no intention or vision or
Mhm.
thought of creating this company. I was trying to retire early. That was
Yeah.
it. I didn't want to be working until I was 60 or 70 years old. I wanted to retire at 35. That was my number,
Mhm.
and then just be done. So anyway, we went in and that's how we structured it and had a
Simple.
pretty,
I mean, very, very simple. It's amazing how complex. We're working on one right now, and the lender is like throwing all kinds of. They want us to have a Delaware, like two Delaware LLCs, and a holding and all this other crap. But man, I wish it was just as simple as what you guys did. Just you own half, I own half. Let's do this. But
yeah, we had good intentions. We thought that we'd both be working on it equally, but in any partnership, there's always going to be one person who's just going to kind of take the lead.
Mhm.
And I kind of had a leg up on it. Well, not intentionally, but
Mhm.
and I'll tell you here in a minute why. But over the first 6 months of ownership, though, we really kind of got that baptism by fire.
Yeah.
So right out of the gate, we lost 15% occupancy, which
Okay.
isn't really hard to do when you're 26 units. It was 4 units moved out. And next thing you know, we're at 85% occupied. Then we got a notice from our insurance company that while we did pay for insurance, the insurance that the broker sold us was fraudulent. So he got scammed, and by default, we are scammed. So we
Yeah.
had our attorney send them a letter, just said, you're taking accountability for any claims that we have if something happens. And by the
Mhm.
way, this is like June.
Mhm.
So like going into hurricane season, which you'll never like try. It's
Mhm.
impossible to get insurance on a deal that you've already acquired in the middle of hurricane season. It was really, really tough. So yeah, we did end up getting that done a month or so later. But so that happened. And then, we're renovating, we're installing
Mhm.
central AC. The property had window units. So we're putting central AC to do that. You got to get a permit.
Yep.
To get the permit, you got to submit your environmental,
Mhm.
which everybody does at these closings.
Mhm.
We unfortunately didn't already have the environmental, maybe because the lender we were using back then was a lender called Bank of Internet USA, and they were just this weird online bank. And
Bank of Internet.
yeah,
Sounds legit.
it was a legit bank.
Yeah.
They were real. They
Mhm.
gave us money.
They gave you some money. Yeah. So.
So, but they were not multifamily lenders. And also,
Mhm.
multifamily wasn't that mature of a market back then. It was
Yeah.
still kind of a maturing market. And I don't know if all lenders required it or didn't require it, or maybe we just got, or these guys just didn't, but we didn't have one. We got an environmental, submitted for the permit. When we actually reviewed the environmental, the came back hot for asbestos.
Ooh.
And being in oil and gas, obviously, I know the dangers of that. And so we immediately, well, first, there's a couple of explicitives that were shouted and emailed back and forth to each other,
Yeah.
my partner and I. But then shortly after, emails were sent to all the contractors, stop work, we're out of money, go home. And we just kind of dodged all these really inquiring emails they got. So it was like 1.5% to 2% in just the joint compound. So it's crazy. They put that stuff in everything back in the day.
Yeah.
We're actually doing a deal. It's a 70-unit property. We're going to be tearing it down and building 300 units on top.
Yeah.
But we had to do an environmental, and this is a quick detour, but
Yeah.
had to do an assessment of it. And it had asbestos, and it had it in the caulking for the window, had asbestos in it.
Oh.
And so I was like, oh, that's interesting. I didn't, like, every single window had asbestos in the caulking around the panes. So anyway, and then obviously they had it in the floors and all that. But
now, are you talking, we would say the environmental inspection, you're talking about the normal phase one, or is this a different one?
So we had to do a phase one, and then the phase one will recommend, they see something, they'll say, we recommend a phase two, which then they go in and do the actual asbestos survey. So came back, figure out how much we had and where it was. So that was, like month 4, I think. And then month 6, I got notice from Exxon I was being let go. So at the 6-month mark, got let go, lost my dream job, which was, obviously a big blow to the ego, and also a big blow to the bank account. And even bigger when your property is negative cash flowing and you are feeding it money, and now you no longer have money. So I joined a real estate group the next day and dropped 10 grand to join, become one of their multifamily members, and kind of surrounded myself with the right network. But that was my kind of first baptism by fire. And because I'd gotten let go, now I have all of a sudden all this free time. And so I was telling you earlier, why I took the lead. Well, I had no job. So I just focused on multifamily because I was really trying to save my butt on this deal. Everything, or a big chunk of what I'd made over the last couple of years when I was overseas, I just dumped into that one deal, and I was about to lose everything, and that would have been really bad.
Yeah. Now, the story does have a happy ending. I think you're telling me before we started recording that property just sold, right?
Yeah. So we actually just sold it about 2 weeks ago. It had a happier ending. So we joined that real estate club, surround ourselves with the right network. Your network is everything. I actually met my 2 partners at that organization as well. We went in, we did this crazy monster renovation. So we bought that property for $650,000. We ended up spending $700,000 on a renovation. We vacated it, brought in, did the abatement, renovated it, leased it back up, and then we refinanced it out. And on the refinance, we made a 2x return. So we had already doubled our money on the refi.
Okay, nice.
So we used that to just kind of reinvest into deals. And we'd held the property for 10 more years. Just, it was cash flowing. It was doing okay. I mean, it wasn't a lot of money, but it was something. And mostly we were kind of waiting for the market to improve or really find something to do with it. But also it was our first one, it's like, why sell? There was rumors also that they were building a bullet train between Houston and Dallas, and the hub was going to be like right next to our property.
Oh.
So we were just holding and waiting to see what the results would be.
Had they done that, the price of that thing would have skyrocketed. I mean,
absolutely.
So yeah.
And it just kept getting delayed and delayed and delayed. And so about 6 months ago, we got approached by, or maybe 9 months ago, we were approached by a nonprofit to come in and, buy the property. What they do is they provide housing for sex trafficked women. And in Houston, unfortunately, we are kind of the hub for that. It's not a good thing to have. But anyway, there's a lot of that in Houston. And so there's a lot of organizations that are trying to address that problem. And so they were looking for a home or property to convert and house all these women. And so they came to me and I said, thanks guys, not interested, but there's a property down the street you can buy. They'd probably be interested. And then they spent a few months with them and they were unable to come to any kind of deal. And that guy was really kind of being not very nice with them and not giving them a good deal at all, and just having all these weird clawbacks. So they came back one more time and I said, fine. I just kind of felt a calling and felt, now was kind of the time to do something with it. And it was going to go to a good home. And, and we had already tried other development options. And so we knew this is probably the best use for the site. And they hit our number as well. It's like, here's our number, and they hit our number. So we ended up selling it just a few weeks ago. Overall return to investors about a 5x multiple, which is great, but that was also a product of the time, right? I bought it for a 14 cap.
Oh yeah,
it's trading now at 5.5, even 6s. So that was a lot of cap rate compression. We also increased NOI. We tripled the NOI. So we we increased a lot of the NOI, but there's a lot of forces, a lot of wind to our backs, if you will, on that deal. But it is a fun story to tell, and learned a lot, and glad to see that it kind of went to a better home.
Yeah. First properties tend to be kind of like the baptism by fire, like the people talk about, where it's just, you don't know what you don't know going in there. And yeah, I think that's similar for our first property, same thing. It's you get in, you buy it, and it's occupancy goes down. You're like, oh crap, but anyway, cool. Hey, thanks for sharing that. Appreciate that. So you bought that, you said in 2012, is that right? Okay. And sold in 24, 5x your returns.
Oh, we bought in technically October of 2011, but
Okay.
yeah.
Awesome. Well, congratulations on that sale. And, just kind of shows that you put enough time back behind real estate. You can sell at any time.
I'll tell you one of the things that we learned. So the sale price that we sold for was basically the same price that we appraised for back in 2014. So we could have sold it 10 years ago for the same number and
really?
made another $1.5 million on it. But instead we held it. And so obviously hindsight 2020, but I mean, things were going well. We weren't having any issue buying deals or selling, or sorry, we weren't having issue raising capital. And so we just kind of let the opportunity, there was a greater opportunity for it. But I think being cognizant of the equity you have in deals and making sure you're not holding on to them too long, because is that debt equity, is it better served sitting in that property, or is it better served out of the property and redeployed somewhere else?
Yeah. Now, speaking of the equity, I mean, there's a couple of ways to tap into equity. You mentioned that you refinanced, several years ago. Was that the only time you guys refinanced, or did you guys periodically refinance over time?
That was the only time. We just refinanced that one time. We probably got a bigger loan than we should have. It worked out well. We cash flowed, mostly because also taxes. One of the benefits that also was to our favor was the taxes hadn't caught up to the valuation yet. So we were still getting taxed on a 650 valuation when it was
nice.
$3.5 million property. And so it was a big difference. And once they eventually did catch up with taxes, but we should have, again, hindsight, opportunity probably would have sold for a bit more.
Yeah. Now you mentioned it was you sold it at roughly the same price as the 2014 appraisal. Is that partially attributed to the the last 2 years multifamily prices have slid quite a bit. I'm assuming, 2 years ago, where do you think you could have sold that? Or were you guys even looking at numbers at that point?
Yeah, 2 years ago, we probably could have sold it for more.
Okay.
Definitely could have sold it for more. So probably missed the opportunity there. But we were at that time, 2 years ago, we were pretty heavy into a development plan on that project. We were actually looking at even putting build to rent on that site, but the dirt cost was too much for us. We would have to sell the property for a loss, and we're going to do that.
Yeah, it's a hindsight thing. Right now you can look back and say, crap, why didn't I sell in 2022, or early 22 or late 21?
You get so caught up in the weeds sometimes on these deals, on the details. And sometimes it's good just to take a step back and look at the macro and be like, all right, here's the equity I have in these deals that's untapped. And so I think if you take those bigger views, and it's hard, right? Because when you're in the middle of things and everything's going on, but if possible, try and give yourself some quiet time where you can just kind of reflect and review on your portfolio.
Yeah, we just sold one last week, and when the partnership got together to make the decision, it was a 3-1 vote. And, I like the idea of holding real estate long term. I like the idea of holding real estate long term. And also, I know where the market's at right now. It's just like, why are we selling at the worst point? Right now is the worst time to sell that we've seen in a long, long time. But, it was a 3-1 vote. I was outvoted. But now after it's sold, I'm looking back at it, that asset wasn't doing extremely well. It's one of these things where, when you start looking at things long term, I'm starting to think the way my partners were. And their argument was, it is cash flowing, but it's not a strong cash flowing property. We don't think the market's going to be improving. We don't think the value is going to go up much more. And we sold as well. I think hindsight, if I were to go back 6-8 months ago and, make a vote again, I probably would have said, let's do it for those reasons. But a good idea, step back, look at your portfolio, look at your properties. Just one thing I didn't do. I was just kind of following the idealistic worst time to sell is now, but I think a lot of people are really happy to have that money back and be able to use it somewhere else.
Yeah, definitely. Holding long term is great. It's good when your capital's out. It's a different analysis when you've gotten all your capital back. But even then, once your capital's out, then that means imagine how much untapped equity is in your deal. So keeping your deals properly leveraged up and keeping good debt on them. So when rates come back down and you've got some deals that you want to hold long term, make sure you're refinancing them and that your debt strategy matches your kind of hold strategy.
Yeah, I like that. Make sure your strategy matches your hold strategy. That's an early mistake I made as well. Gosh, our first property, I don't remember if we got a 10 or a 12-year Fannie Mae loan, but we were only planning on holding the property 5 to 7. And I hate to say this, but I didn't know what yield maintenance meant at the time. And when we tried to sell that 3 or 4 years later, I found out and I'm like, oh my gosh, what did we do? But yeah,
That was
speaking of,
expensive. That was the expensive lesson right there.
well, we got the loan at 4.9. This is 2019, before the rates were in the threes. But yeah, we got the loan at 4.9 and we ended up having to hold it through the really, really good time to sell. I mean, when rates were back up into the high fours, low fives, all of a sudden getting somebody to assume it. So it ended up costing us because we couldn't sell when things were at the peak. But, not too long afterwards, we had an interested buyer that was okay assuming a 4.9% loan when, the market at the time was probably 5.5. But it ended up working out just because of the market factors. But
Yeah.
yeah, man, good point there. All right, we kind of went in detail on that first deal. What have you been doing lately?
Yeah, lately, so we're doing mostly developments now. Is kind of what we're focused on. We're doing some tax credit opportunity zone developments, and really that's kind of our focus is going to be. We're getting away from the older product and going into either building new or acquiring newer. So we're launching. We've got our acquisition fund that's getting launched in the next couple of months. $100 million equity fund targeting 90s and newer vintage properties within the Houston area, interviewing for a VP of capital, which I think by the time this airs, we'll have already hired the person, but we've got two really strong candidates that'll be, we'll make a decision on by end of this month. Yeah, that's really just trying to keep our deals going. It's a tough market right now. We did a few loan modifications on a couple of properties to get things going, and negotiating the sale of one property right now as well. So that's been just kind of managing the portfolio, getting ready for some growth in the future, and then focusing on our development side, which it's tough, man. Development is so tough. It's completely different than acquisitions, and it's a very iterative process, very frustrating process, very long, time-consuming process, and a very expensive process because you're going to make some mistakes and they're going to be expensive.
Yeah, that's something that people ask me all the time. Are you ever going to do ground up? Or are you interested in doing ground up? And right now, I'm happy to say no. I'm going to keep on doing what I'm doing. But I think the closest I'm going to come from development in the next couple of years is buying something at C of O, so something that just developed and, maybe has a certificate of occupancy, maybe not, or maybe just finished leasing up. But I've heard a lot of people say the same thing, that there's just a lot of stuff going on, a lot of little things that can just delay the process for a long time. But
absolutely, with development, the biggest challenge and risk is getting to groundbreaking. But if you're looking to come in as an investor or a partner with a developer, if they've already gotten the project to the point where it's fully designed, it's permitted, if they're just doing debt and equity, I think it's a different animal at that point, because really you've got your contract with the GC, and once they close on a loan, you're just managing the contract. They build the property and then it's stabilized, and now you're in a deal. Your basis is much lower than market, and so you're able to make a lot more money. So it's just on that front end part as a developer that you can take a lot of lessons.
Now, on the developments you're doing, are you guys basically going to recapitalize and hold them, or what's your plan on that?
Some of them we are. We've got two that are long term, and the third one's a shorter term. The biggest one's actually a shorter term. It's a 3 to 4 year hold in and out. Everything else is kind of long term hold. Our opportunity zone deal is a long 10-year hold.
Okay.
Our deal that we're building, Creekside, it's a garden style deal. That one's a shorter term for the initial investors going in, but we're going to be holding it, recapitalizing it long term
Okay.
and building out multiple phases.
So just to make sure we're saying the same thing on the when you say the long-term hold, did you syndicate all of these as well? Investor money and everything?
Yeah, well, we're in that process right now.
Okay.
So we're raising equity for one of them, and the other two are still in detailed design.
Okay. So with the 10-year hold period, that takes you through the development. And so the same investors are essentially in for the development period and for the first 5 to 8 years of the hold as well. Is that what you're saying with the 10-year hold?
Correct.
Okay, got it. That's what I assumed.
Yeah.
So,
But that one's a 10-year mostly because it's opportunity zone.
mhm,
If we get a fund, which is what we're targeting
mhm,
to invest, then we have to hold it for 10 years to get the maximum benefit. And that deal has, we're doing a tax credit program on it. And we've designed the property to fit that program
mhm.
for the maximum return to the investor.
Okay.
And so I mean, we're double digit cash on cash every year
Nice.
for 8 years, paid back the capital within year 6. It's a strong deal, almost a 19 IRR over 10 years, which that's
Yeah.
really hard to do.
Yeah, it is hard. I mean, especially because IRR is time weighted. And I know you know this. I'm speaking more to the people who are listening right now. You know, the longer you hold a project, the lower your IRR tends to be because that big windfall is so far down the road. It kind of dilutes that number a lot.
A 3x multiple over 10
Yeah.
years.
Okay. Nice. Those are pretty solid numbers there. So, well, awesome. What was the biggest reason you went from buying existing, into development?
At the time, it was because we saw the spread between cap rates and yield on costs really kind of compressing. It was,
Mhm.
I'm buying it for very similar to what I'm building it for. I
Yeah.
should just build it and have something new instead of having an older product for that same basis.
Yeah.
So that was the main reason was, and also when you look at the real estate cycle, you
Mhm.
have those 4 quadrants there. There's always that one quadrant where it's a terrible time to buy, but a great time to build.
Mhm.
And we wanted to be able to remain active throughout the entire real estate cycle. So therefore, we had to learn how to build apartment complexes. But then another thing is, because we're always on the acquisition side, we end up seeing deals that other developers don't see. So like
Yeah.
two of our developments are covered land plays or existing properties that we're tearing down and building on top of that were completely glanced over by developers, or
Mhm.
maybe just weren't aware of them because the brokers didn't really know what they had. And so they're
Yeah.
just trying to sell it like they're trying to sell any other property.
Mhm.
And so because we're in that market, in both markets, we get to see those opportunities to use that insight of development to make better acquisitions. The last deal we bought, one of the exit scenarios is to exit out as a multi-phased development because it's 15 acres of land and right next to the Heights area. It's a great submarket. And so there's a strategy there. We renovate, we hold it for 5 to 7 years, and then we start tearing it down in phases to
Mhm.
do and build like 1,500 units on the site. So you can do probably not that much, but you could do a lot of developments if you have that kind of insight and know it's possible on these
Yeah.
deals.
Yeah, I mean, we're buying a property right now. Speaking of, it's something that's not in my wheelhouse right now, but it's supposed to be a 10-year hold. But the area around it, it's in one of these areas where parking lots are being turned into multifamily complexes. And so you're seeing brand new multifamily pop up. And I think the landscape around this area is going to be completely different, 5 to 10 years from now. I'm scratching my head. I'm like, we've got 3 acres, 50 units on 3 acres. That's fairly low density. Anyway, one thing that's been going through my mind is just that idea as an exit, and instead of selling what is now a 60-year-old building and will be a 70-year-old building.
Yeah, imagine that. One of my concerns, right? That's why we're not doing these older properties anymore because eventually the music's going to stop,
Yeah.
and it's not going to be an abrupt stop, right? But it's going to be cap rates are going to be expanding
It's
on
like a
the older
battery
product.
going dead on a record player. It just slowly gets, but
Yeah.
yeah.
Because nobody's going to want the older stuff,
Mhm.
and you're going to have a hard time exiting out of deals for an attractive cap rate. Because I
Yeah.
think that's really what's going to happen is that cap rates you're going to sell it for a higher and higher cap rate to entice somebody to come in because really they're just buying cash flow at that point. And as you know, it's very hard to outrun a cap rate you're not going to be able to outgrow with the NOI a cap rate that's expanding on you. So
Yeah.
you're going to be in a tough spot. But I think it's that, those properties will be reserved for people kind of getting in and learning the ropes, because they'll still be more affordable than the newer stuff.
Mhm. I like what you said, learn how to build. I mean, because it was something going through my mind. I'm thinking it's not something we're advertising to anybody, but in the back of my head, I'm seeing these brand new apartment complexes go in all over the place, townhomes and new developments. I'm thinking, 10 years from now, the highest and best use might be bulldoze and build, and if
I mean,
I between now and then learn how to build, boom.
I've been learning how to do development for the last 7 years, just
Mhm.
quietly in the background,
Yep.
working on our different projects, meeting with developers, and at a much more accelerated pace the last 4 years.
Mhm.
But it's tough.
Yeah. Yeah. Well, it's going to be it'll be a future project for me at best, but
And I'll tell you one of the things that we do. So we have two clients. So we're doing, basically we're a consultant. So we're a development consultant for them.
Yep.
It's their land, it's their equity. We're coming in, we're partnering with them. We're building a property how they want. And then we're leaving and they keep it. And we got another gentleman where we're building some apartments on one of his sites as well. So, and we're doing some development service work for anybody who's interested, where they think, hey, I've got something that might be of interest. I want to develop myself, but don't really have the expertise. We're here for that as well.
Yeah.
Because a lot of times we find that people, they've held that property for a very long time. Maybe, they don't necessarily want to sell it to a developer. They'd rather just develop it themselves and continue to hold it for that period. So that's what development service is for.
Yeah. Awesome. Awesome. Well, hey, we're running out of time. Just realized that we've almost been talking for a full hour already, but let's kind of wrap this up. A couple of questions to finish up. First one is, what advice would you give to somebody who is just starting out in the apartment investing business?
I would say have patience and don't try to go too fast, because this is one of those industries, speed definitely kills. And if you're trying to grow too fast, we've seen it before, you can definitely get yourself into a jam. It's like building a fire, don't just try to put the logs on, start off with the twigs, get it nice and red hot, just do a bunch of small things. And then once you've really got a nice base, then try to start doing some bigger stuff. I think people will try and go after bigger projects too fast. And it's like, if you just built that fire, got it more red hot, then try to put the logs on, you'd be so much further ahead than you are now.
Yeah, I like that. And I mean, I think we've both seen people that, started investing, about the time I did, 2019, that grew really, really fast and are having problems right now. So,
yeah. And there are some that grow fast and they do okay, but they are definitely the exception. It's rare. The vast majority of people, you're better off kind of taking your time. And real estate's a long-term game. I mean, nobody does real estate for a few years and gets out and it's done. Yeah. I mean, you're in real estate for the long haul. So what's the rush?
Yeah. And come to think of it, probably subject for a different podcast, but first year I closed on 3, second year on 5. Within an 18-month period, when we ended up with 8 properties, we were experiencing a lot of growing pains. So I wouldn't tell you that at the time. I'll tell you that now. But all right, next question. What's next for you? I think. Did we already talk about that? I think we already talked about that a little bit. Yeah. But anyway, go ahead.
Development. Yeah. For us, what's next is development, launching this fund, and then the development services, helping other people to do their own developments.
Okay. Awesome. Awesome. And last question, how can listeners learn more about you?
So easiest way, go to my name, josephbramante.com. All my information is there. You can connect with me. You can join our mailing list. If they are I'll tell you what's kind of to your second question, your previous one. One of the things that's coming out in July, we are launching a course for kind of intermediate and budding sponsors and syndicators. It's got a minimum. You have to have done at least $100 million worth of acquisitions. We're not here trying to teach you how to buy your first deal, but we're going to take you to that next level where you've done a few deals, you know some things, you're a little bit dangerous, and we're going to take you to that next level and get you ready to scale quickly and avoid a lot of these lessons and help you do everything from negotiate better loans to kind of structure your company better, to do better underwriting, the full 9. So that's coming out in July. If you're if that applies to you, reach out, josephbramante.com. Let's get in touch.
Put
It's
me
good
on
reminder.
that list. Put me on that list. So always worth learning more. Yeah. So we'll make sure that information hits the show notes so anybody who's there can find it, tap it, and let that internet thing whisk you away. So all right. Well, hey, thanks a lot. Appreciate your time, and we'll bring you on again, I'm sure, within 6 months to talk again, because that's about what we do.
All right. Thanks. See you, Brian.